Dividends sound simple. You buy a stock and it pays you cash, almost like passive income just showing up. But let's separate the story from the reality where dividend money comes from and whether it really puts you ahead. A dividend is a cash payment a company sends to its shareholders. It usually comes from profits, although sometimes it can come from retained earnings built up over time. When a company pays a dividend, it is choosing to return part of its cash to its investors instead of reinvesting it back into the business. Here is the key point many people miss. Dividend money does not come from nowhere. It comes from the company itself. When a dividend is paid, the company cash balance goes down. On the ex-dividend date, the stock price usually drops by roughly the dividend amount. That is not market accident. It reflects the fact that cash has left the company. So why do companies pay dividends at all? Often it is because they generate steady cash flow and do not have many high return projects to reinvest in. Paying dividends signals stability and discipline. Dividends also attract certain investors, especially those looking for income or predictability. This is where opinions split. In theory, dividends do not magically increase your wealth. A dollar paid out as a dividend is a dollar no longer inside the company. What matters is total return. That includes price appreciation plus dividends. Some investors prefer dividends because they provide cash flow. Others prefer growth because gains stay invested automatically. Instead of dividends, many companies choose share buybacks. Buybacks reduce the number of total shares outstanding, which can increase earnings per share and often boost the stock price. Economically, dividends and buybacks are two ways of returning value to shareholders. The difference is how and when investors receive that value. Taxes matter here. In many countries, dividends are taxed when you receive them. Capital gains are often taxed only when you sell. That difference can affect after tax returns, especially for long term investors. This is why dividends are not automatically better or worse. Context matters. Despite all this, many investors love dividends. They create discipline. They provide visible cash flow. And for retirees or income investors, they reduce the need to sell assets during market downturns. Dividends are not about excitement, they're about consistency. Like we learned, dividends are not free money. They're one way companies return value to shareholders. Whether they help you depends on your goals, your tax situation, and how you invest over time. Understanding how dividends work puts you ahead of most investors. If you want to understand money and navigate the system without the noise, subscribe and tap the bell. And tell me in the comments, do you prefer dividends, growth, or mix of both? See you all in my next video.